when we ask an investing professional what they're looking at in today's markets. We're back again with Brooke Thackray. He's our featured guest, also research analyst at Global X, to talk about something, Brooke, that a lot of Canadians are talking about. We always talk about it, and that's the value of the Canadian dollar, which has plunged on a variety of factors. Turmoil in Ottawa is one of them. We are now sub 70 cents for only the fourth time since the mid 90s, and you can go back through the collapse in the oil price of 2016, the fiscal crisis of the 90s. There have been different catalysts over the years for a weak Canadian dollar, and you think this may not be the bottom?
No, I think that we could see the Canadian dollar actually move lower at this point because, first of all, the U.S. economy is actually doing quite well relative to all the economies in the world.
Right.
Canada is actually in a weaker situation. The two big drivers for the Canadian dollar in the past have been the oil price, because we are a net exporter of oil, and also to the spread between the two-year yield. And we've seen the yield in the U.S. on the two-year just go heading higher. We've seen all the interest rates heading higher in the U.S. That's partly a reflection of economic expectations. And as a result, we've seen the Canadian dollar pulling back. And right now, Canada's in a little bit of political turmoil at the same time. So there's not a lot positive to be going for Canada at this point. And I see it actually heading lower, possibly over time.
The differential in rates is the big one, is it not? We're going to actually, let's talk about this right now. These are Canadian recessions, correct? That was the gold bars rising vertically in this graph?
Yeah, these are Canadian recessions. This is how much one Canadian dollar will buy in US dollars. So when it's rising, that means that the Canadian dollar is outperforming. When it's falling, the line's declining, that means the Canadian dollar is weakening. And you can see that 70-cent level here. We were in 2016. We went down to that level as well. And we've touched that level a few times. Now we've broken below it, and we are at around 69 cents. But you can see here a couple things. First of all, as we head into tough economic times, you can look back to 2008, 2009. The Canadian dollar tends to weaken in tougher economic times. Investors gravitate towards the U.S. dollar, particularly in a global recession. And if we see the same thing take place here, right now we're seeing a global slowing down, really. The U.S. is the only one it's one of the few countries that's actually doing quite well. But we could see further weakness globally, and that will attract more people to the U.S. dollar. Which will also push the Canadian dollar down lower. So there's not a lot of positive catalysts for the Canadian dollar to come back up, and it's going to be hard for it to break through that 70-cent level again. I actually think we might actually see at some point over the next year down 67, 65 cents perhaps as well. If we continue to see Canada slow down.
Is this a U.S. dollar story or a Canadian dollar story primarily? I mean, because other world currencies are also down against the greenback. As you said, the U.S. economy really the only major global economy that is doing well.
It's both. So the U.S. dollar has been outperforming most currencies around the world. It's quite strong. If you look at the Dixie relative to the basket of world currencies against the euro, the U.S. dollar has been performing quite well. And so when that happens, it's hard for the Canadian dollar to actually do well. But it's also the Canadian side, because we are seeing economic slowdown here at this point. And so the world is not good for the Canadian dollar at this point.
One choice that investors in ETFs have is to choose. There are many ETFs out there that come in hedged versions that hedge out the exchange rate risk versus the U.S. dollar. Would this be the time to choose a Canadian dollar hedged ETF?
Well, I would say on the other side. So when you make an investment into the U.S., you buy a U.S. stock or let's say an ETF. You're making, in that case, two choices. One is on the ETF itself,
right,
and the currency. Because if you buy it unhedged, you're saying, well, I expect the U.S. dollar to do well relative to the Canadian dollar. And if you feel that that's not the case, you would typically buy a hedged currency ETF. And therefore, if the U.S. dollar does poorly, you're being hedged to the Canadian dollar. So you're making the currency decision and the underlying security decision. And at this point, the preference would be to lean towards more unhedged investing into the U.S.
With the Canadian dollar being at an historic low.
Yes. Well, it's a historic low, but I still think it can move lower here. I think it's going to have trouble rising here. There's not a lot of impetus.
That's Brooke